Good evening. A very warm welcome to all participants. Firstly, I'd like to thank each one of you to have spared time and spare time to attend this knowledge sharing platform initiative by Kotak Securities. Today we're going to be talking about derivatives, various concepts of derivatives, along with that application and what is our outlook on the market from here on. Recent times have been extremely challenging, in particular for derivative traders. The market witnessed a lot of volatility in the month of August, September, October, and after which in the month of November we've seen some stabilization. So there are a lot of parameters which can help us take appropriate decisions, manage risk well on the basis of derivative parameters. So we'll be walking you through a few of them, some concepts basic which in our opinion require a lot of clarity, and along with that, what do we think of the markets from here on. Just a brief introduction. My name is Sahaj Agrawal. I've been with Kotak for the last 10 years into the derivative research field, managing clients, retail as well as HNI. And currently we have a team of around 4 to 5 analysts under me, working on various aspects of the derivative segment. So yes, we'll start the presentation, and later on we'll cater to your questions and answers. So let's start the presentation. So once again, welcome to this knowledge sharing platform initiative by Kotak Securities. Today's focus is going to be on the derivatives aspect of the market. So let's start. Just a brief on the team for Kotak Derivative Research. Sahaj Agrawal, I'm heading the team. Along with me, we have 3 analysts, Mr. Malay Gandhi, Mr. Prashant Lalu, and Mr. Prasanjit Viswas. Each of them have their own strengths, and we tend to capitalize on that to ensure that a wider range of offerings are available with a high accuracy rate. And that's how we cater to our clients. The agenda for today is going to be, first of all, we'll be covering certain basic concepts of derivatives. After that, certain tools which are used for analyzing the derivative market. How should one approach the derivative data? Thirdly, the market outlook from here on. What are our expectations going ahead in the short term as well as in the medium term, along with certain supporting parameters for the same, followed by the question and answer session. So let's begin with the basic concepts of derivatives. Now, first of all, just a brief on what is derivatives. Derivatives per se, as the name implies, derives its value from an underlying. Now, that underlying could be a stock, could be an index. Across in the world, we have in the financial markets, we have weather derivatives, currency derivatives, commodity derivatives. At Kotak Securities, we cater to your requirements of equity derivatives, which include stocks as well as index, currency derivatives, and commodity derivatives. Now, these are the various, these are the products which are widely traded in India, and at Kotak Derivative Research, we cater to our clients with respect to these particular products. Derivatives would have 2 particular components. One are structured derivatives, and then you have exchange traded derivatives. Structured derivatives would be negotiated derivatives between 2 individual parties. So it could be a bank and an individual, it could be 2 individuals. And exchange traded derivatives are the derivatives that we widely trade on. So you talk about the Nifty futures, Nifty options, stock futures, stock options. All of that would fall under the category of exchange traded derivatives. Now, derivatives per se, as I mentioned, they derive their value from an underlying. And without an underlying, the derivative would not have any value. The second part is, and the most important component is, as against the cash segment in which we trade, derivatives is a leveraged product. So as soon as you talk about leverage, you're talking about taking positions by paying only a certain sum. So just an example, Nifty futures, you can trade you can trade worth 100 rupees by just paying a margin of 10 rupees. So the point that I'm trying to drive over here is, as soon as you talk about a leverage instrument in terms of derivatives, the risk directly increases as compared to trading in the cash segment. So the lower the margin requirement or the higher the leverage, the higher the risk is. Now whenever we talk about a high risk, it is always directly implies that there is a high return also associated with the same. So whenever one is looking at entering into derivatives or already trading derivatives, it is extremely important to have a risk management in place, because without risk management, your capital could go haywire in a very short span of time in case if you witness extreme volatility. So risk management goes hand in hand with derivatives. Whenever one wants to trade derivatives, is planning to do derivatives, or is already doing derivatives, the risk management should be a top priority which should be taken care of. The basic instruments of derivatives that are available to us as of now, in which we trade more often, would be the futures, the options. Within the option space, we have call options as well as put options. Now, just to give a brief on these, futures would basically have a linear return. So when we talk about a linear return, as your underlying moves, your futures profitability will get impacted. So just to take an example, if talk about a stock say worth rupees 100 trading right now, if you take a position in the futures segment, point number one, you will be landing up paying an approximate margin of 10 to 15% on that particular underlying. So your investment is only rupees 10 to 15. So let's round it up and keep it at 15% margin. So for taking a position worth 100 rupees, you are investing only 15 rupees right now. Now, as the underlying goes up from 100 to 105, right, your futures also tend to gain proportionately. So you have a return of 5 rupees on a leveraged investment of 15 rupees, which is the margin that you have paid. Similarly, if the underlying go is down by 5 rupees, you have a negative impact of 5 rupees on your positions. So with respect to futures segment, there is a linear return associated. As compared to that, when we talk about the option segment, we have two particular instruments in the same. One is the call option and second is the put option. Call options are usually traded when one has a long view on the underlying. So if you are bullish on a particular underlying, so you're bullish on the Nifty right now, you would want to buy certain call options. Depending on what your outlook is, within what time frame are you looking at achieving the particular target that you have in mind or as per your research. Similarly, when you trade put options, you are talking about the underlying falling or having a negative impact on the same. So if I'm expecting a particular underlying or a stock to go down, I would want to take a buy position in put options, right? So calls and puts, within these options also you have two possible situations wherein you could land up buying call options and put options, or you could land up selling call options and put options. Now, to make it very, very clear, selling options is one of the riskiest propositions in the derivative space. As mentioned earlier, whenever we're talking about derivatives, we're talking about risk management, we're talking about managing the risk of the positions taken well. So the most extreme position that one takes is when writes call options and put options, because over here the profitability is limited while the risk that you're taking on your books is unlimited, right? So just a suggestion, if you are actively doing or intend to do writing, then it is always better to have an appropriate risk model in place and then implement the strategies that you are looking at. What are the basic usages of derivatives? Now, there are three primarily uses of derivatives. One is speculation, then you have hedging, and then you have arbitrage. In today's times, the most of the activity in the derivative space happens on account of speculation. So I would say 70% of the volumes that happen on the exchange today in the derivative space would account for speculation, followed by arbitrage, and then a very limited portion of the volumes happen on the hedging space, because hedging per se is not an activity which happens on a daily basis. It is a one-time position that is taken, and then depending on the requirement, dynamic management happens on the same. So speculation happens to be the most volume contributing activity within the derivative space in India as well as globally, followed by arbitrage and then hedging. Now we come to the terminologies. Now I am assuming that we all know basic and common terminologies like the strike price, the spot, the expiry, etc. So we would not be touching upon them right now. However, I feel there are certain elements, certain concepts in the derivative space which require a lot of conceptual clarity. Rather than using these terms in a rather loosely, I think having a very appropriate understanding of the same will help us gain more knowledge in the derivative space and take appropriate decisions at the right time. To start off with, we're going to be talking about open interest, followed by rollover, then what is the basis, which is the premium or the discount in the future space, and a brief on the option pricing. Due to lack of time, we would not be able to cover the various other aspects as well, but we would incorporate these in the series of the webinars that we intend to carry out. A few of them have been mentioned on the slide, which is implied volatility, in the money, at the money, out of the money options, put call ratio, put call parity, to name a few, right? So in interest of time, we've limited 4 concepts right now, which is open interest, rollover, basis premium, and the options pricing. So let's start with the open interest. Now what is open interest? Open interest as a term is very simple. It basically indicates the number of outstanding contracts in a particular underlying. So today when I say that Nifty futures has an open interest of say 2 crore shares, that means that there are 2 crore buyers in Nifty and parallelly there are 2 crore sellers in the index, right? So a high level of open interest at times indicates that the leveraged positions taken in a particular underlying are extremely high, and that indirectly implies that the possibility of an increased movement or increased volatility going ahead remains extremely high. Okay. Another important point is, as I just mentioned with the example of Nifty, when there are 2 crore, when there is a 2 crore open interest in Nifty futures, that basically indicates that there are 2 crore buyers and 2 crore sellers. Conceptually, in our experience, we've seen people misinterpreting the open interest number, and that's why we thought that it is extremely important to incorporate this concept in this knowledge sharing platform. Now, another question that we usually come across is how many are long and how many are short. So ideally, it is not possible to dissect the open interest number into a long open interest number or the short open interest number. What matters over here is the sentiment. So if your underlying sentiment is positive, then you would expect buyers to be stronger and the market to move in their favor. Now when I say sentiment, it is basically the undertone of the market and how the market is expected to play out going ahead. There is no formula to gauge the sentiment in terms of 1 + 1 = 2. That comes from experience and a lot of research, and even from technical analysis one can gauge as to what is the sentiment. Just to walk you through a brief example of open interest, we have a very brief situation over here. Say on a particular date, day 1, A buys 1 Nifty future, B sells 1 Nifty future, right? So basically this is a contract between A and B with the exchange in between, since we are trading in the futures instrument. So the open interest becomes 1. Now A lands up buying another Nifty future, and now we have C, which is another counterparty on the other hand, selling 1 Nifty future. So now we have the open interest which rises from 1 to 2, right? Now A reduces his position on day 3 and sells 1 future, and D comes into the picture replacing A. So if you see over here what has happened, the parties have exchanged but the positions remains the same. That's why you see that the open interest remains stagnant at 2. Now on day 4, you have E coming into the picture, buying 3 contracts of Nifty futures, and F, which again is a new counterparty, coming and selling 3 contracts on the Nifty future front. So over here now the open interest goes up from 2 to 5, right? Now again you have F, which is an existing party, closing one of his sell positions, and D, who had a buy position earlier, now selling the position. So now the open interest continues to remain at 5. So basically what we're trying to say over here, for every contract you would have one buyer and one seller, and that's how the open interest is calculated. And dissecting the open interest number into buying and selling, theoretically it is possible, but on practical terms, when you're actually implementing it, you need to gauge the undertone of the market using research, which could be technical or which could be an alternate research model that one follows, right? So this is about open interest. I hope for those who are not aware about the concept of open interest now have some clarity with respect to the same. Another important terminology which again is widely used, but the interpretation of the same or the understanding of the same remains on the lower side, is the rollover number. Now again, rollover basically means from one particular expiry to the next series, how many positions are actually being carried forward, right? The higher the rollover number, the higher would be the sentiment and the stronger would be the indication of the movement in the underlying, right? So the example that we have over here in the first case, we're seeing in 85% carried forward positions, which is a strong rollover, as compared to, if you see on the example below, we have a weak rollover wherein only 40% positions have been carried forward. Now again, rollover also has to be seen with respect to the broader market sentiment. I will be giving you a live example going ahead as we talk about the tools that we use to analyze, which includes rollover as well, as to how do we actually use the number to gauge the sentiment of the market in terms of the strength. So, in a bullish market, a strong rollover is a strong number, whereas when you have a weak rollover, it basically indicates that possibly the bulls are on break, or there is some exhaustion which is being experienced over here, which could actually result in some interim weakness or correction in the particular underlying or the broader markets. So the concept of rollover again has to be seen in relative to the broader market sentiment. When the sentiment is strong, a strong rollover indicates that the uptrend is going to continue, whereas a weak rollover indicates that the market could take a possible pause. A live example will be shared with you to relate theory with the practical part of rollover going ahead. Next comes the concept of futures pricing. Now, futures, you would have noticed, usually trade at a premium, right? Not to say that they cannot trade at a discount, but they trade at a premium. Now, what is that premium? So, just to draw example from any other asset class, if you're holding any asset, it could be, shares in your demat account, or it could be a physical asset like a property that you're holding. There is always a cost associated with the same in terms of maintenance, in terms of taking care of the property, right? Similarly, when we're taking a position in the futures market, you have an opportunity cost which is associated with the same. You have a transaction cost which is associated with the same. So the basis basically is nothing but the cost of holding the underlying in the futures segment, and the cost basically is nothing but the opportunity cost or the cost of maintaining or holding that particular asset, right? Now, at times we've seen that the futures also does trade in a discount. It doesn't mean at that point of time costs are not involved over there, but there are certain reasons because of which the futures could trade at a discount. The basic ones, namely, you could have a dividend in the underlying, a normal dividend which is declared by any company. In that particular case, the futures start trading at a discount. So one reason for the futures trading at a discount is the dividend. The second one could be a corporate action. So it could be a bonus which is declared, or it could be any other corporate action, a demerger which the a company is undertaking. And the third one, and the most subjective one, is the sentiment. So whenever there is a negative sentiment in the stock, or there is a significant selling pressure from the market sentiments, that also could be a reason why the stock is trading at a discount in the futures segment. Usually you would expect the futures to trade at a premium. Another point which is required over here is, does it mean that whenever the futures is trading at a premium, the market is bullish, or the underlying is bullish, and the futures is trading at a discount, the underlying is weak? Not necessarily always. We've seen at times when the sentiment is extremely positive or euphoric, at that point of time your bases expand significantly, and that is a time which actually can be called as a euphoric phase, which could possibly result in a correction in the market, right? So not necessarily every top will give you an indication that your futures start trading into a discount and this market or the underlying starts correcting. So this needs to be again tracked, monitored to gauge what the sentiment is or how strong the market is in line with the other parameters. So I would say this is more of a suggestive indication rather than a decisive indicator in the derivative space, right? So this is about the futures pricing concept. Now we come to the options pricing concept. There are two components in the options pricing. One is the intrinsic value and the second one is the time value. Both of these constitute and sum up to total up to become the total options premium. So we'll just take a brief example right now. Say a stock is trading at 56 rupees and the 50 strike call option is trading at 8 rupees. Okay. So basically what we mean over here is we want to break up the 8 rupees into two parts. The intrinsic value over here is the difference. All strikes which trade below the current market price would have two components, which would be the intrinsic value and the time value. So options basically derive their value from two aspects: intrinsic value and time value. There are various components while considering or as to how the options premium is particularly decided. So you have the spot price, you have the strike price that you're selecting, you have the time to expiry, you have the volatility, you have the risk-free rate, and you have the dividend. Most important components over here, in my opinion, are time to expiry and volatility. So if your volatility suddenly shoots up, you will see that your even if your underlying remains right there, but the volatility has gone up in the broader markets because of certain events, in that case your options will become expensive, right? And your time to expiry is how far are you from the expiry date of that particular contract. So the further you are away from the expiry date, the more expensive your options would be. And as time passes by, the time component of the option keeps decaying, taking your stock, the option premium down on a regular basis, right? Just to give you an example on volatility, at times you would have witnessed, you've taken say there is a stock which has a particular result which is going to be announced on say tomorrow. Today you land up buying the call option with the expectation that the stock price will shoot up. On the next trading session, after the results, the stock does go up as well, but you don't tend to gain on your options front. Why? Because pre-event, because of the uncertainty aspect, there was a high volatility, and because of which the option price had already gone up to discount the uncertainty in because of the result outcome. As the result is announced, in spite of the fact that your positions were in the right direction, you would not gain as much on your options front, because the volatility component of the option compromises on the has a downward pressure on the option price as against the underlying which has gone up, which has an upside pressure on the option price. So volatility is extremely important to be considered for option traders. So for an option buyer, a low volatility option is always more comfortable because the risk is rather limited, and for option writers or option sellers, a high volatility situation is always more favorable. Obviously there are risks associated with both the cases, and that needs to be managed in an appropriate manner, but these would be the ideal situations depending on whether you are a buyer or a seller. So having spoken about these basic concepts on the derivatives front, which need conceptual clarity, I still believe, broadly for successful trading, I think there are certain pillars which needs to be considered and which needs to have a very, very strong definition before one gets into trading. More say in derivatives because we're talking about leverage over here and we're talking about margin trading over here. Point number one is leverage management, right? So you need to be aware of the kind of leverage that you are taking on your books with respect to the capital that you've committed in the derivative space. You may like one particular stock and you may think that it is expected to do extremely well, but that does not mean you commit your entire capital onto one particular underlying and take aggressive positions. Even in case if you're doing the same, you should have an appropriate hedging strategy or a risk management to ensure that in case an unfavorable outcome happens, what is the step that you are going to be taking to manage the risk that you've taken on your books, right? Second one is always have a trading plan. Ad hoc trading is not going to help you achieve your trading objectives since in times of uncertainty or in times of high volatility, if you don't have an objective plan in place, if you don't have a risk management in place, it's going to be difficult for you. And then rather than taking a conscious financial decision, you could land up taking an emotional decision, right? So having a method, having a money management is extremely important when trading derivatives. The third one is again greed and fear, which all of us have to overcome, because getting emotional with respect to trading doesn't really help or take you places. So usually in euphoric times we'll end up taking aggressive positions, whereas when the market actually is giving you a strong opportunity, like in recent times when your index corrected to 10,000 level, we had more of fear. So one actually has to take a conscious obviously research backed call and ensure that greed and fear are appropriately managed along with your money management and method. We've seen extraordinary results being achieved if you have these three pillars categorically defined and followed with discipline on a continuous basis, right? Every model, every method is going to have its own drawbacks and limitations, but in our experience, having these particular three strong parameters will help you remaining consistent trading all throughout in the market. There is one term that we usually use: to play the game, you have to be in the game. To be in the game, you need to ensure that you have a particular risk management, a particular method, a particular control over your mind to ensure that you remain present in the trading game forever and ever. So this is particular of extreme importance, and 10 years of my experience, I believe having research, having a model, having trading ideas is extremely important, but along with all of that, your pillars should be extremely strong, right? Now we'll shift over to the tools that we use for analysis. Now we'll be talking about say connecting theory with the practical part of the markets, and what are the various tools that one can use in terms of trading. We'll walk you through the certain tools that we use while identifying and gauging opportunities. So first of all, we look at what is the underlying trend of the market. For that, one can use technical analysis, one can use quantitative analysis. Derivative analysis per se will give you an insight into the shorter trend of the market, but the broader trend of the market can be gauged from quantitative analysis or technical analysis, as one may like or one may have a grip upon. Open interest concentration helps you identify the broader range on the market. So today when we talk about the index, you would have a certain call which would have high open interest, and you would have a put which would have high open interest. So basically that gives you a broader range with respect to what the market participants are expecting is the range going to be for the near term. Then we take the top down approach. So basically once we have a clear view on the broader markets, we have a certain view from the derivative space. From the rollovers, we identify cues. From the open interest data, we identify sectors and stocks which look interesting, followed by the technical space. From the technicals, we try and identify where is the momentum, where is volume happened. So having considered all these parameters that I just mentioned, we come up to a view and identify opportunities that are tradable. I'll just walk you through the same. So just giving you a live example, in the current series, if you see over here, the index actually had a weak rollover, right? So that basically gave us an indication in the early part of the series that though the market is closed at recent highs, we closed at the highest point in the November series as we entered into the December series, but the rollover on the broader markets was not very strong. So when I say 100% over here, that basically means that all the indices that are trading on the in the derivative space had a weak rollover. So that basically gave an indication that from here momentum is possibly going to take a pause, and one has to look at opportunities keeping the broader market outlook, which currently is indicating that the market is wanting to consolidate or correct from here on and then take a view in the market. Now after having identified the view on the index with respect to rollovers, then we tend to shift to the sector wise rollover data, which indicates which possible sectors could show some kind of a reversal or strength. So if you see, metals is showing a 73% rollover over here. Last month we saw metals actually had corrected significantly and were trading near their lows. So metal space over here did show some early signs of strength, and that is where we expect, or we saw some kind of an opportunity. Similarly, the infra space also does provide some opportunities. The cement space is exciting. This is all on the positive side. On the negative side, we saw some weakness in the FMCG space. We saw some weakness in the consumption space, right? The NBFC space, particularly, which is the financial services space, witnessed some mixed activity. So what I'm trying to say over here is having the broader market view first, which is weak, right? Then you shift over to the sectors which are showing positive indications, negative indications. Obviously, when your index rollover is low, you would tend to shift, you would tend to see the sectors which are relatively on the weaker side. Or even if you're seeing the sectors on the stronger side, you would have an appropriate support level. You would look at the stock internals and then take positions onto the same. So this is how we look at rollover data for the broader markets and for sectors, followed by open interest, which is seen in stock specifics. Now, having identified the broader market outlook, the sectors, then we shift to the options data, which gives us the broad range. So as of today, the open interest in the Nifty option space, which is the most liquid instrument, is seen in 11,000 call and 10,000 put. So basically we have a broad range over here with the index trading near the resistance of 11,000, and you have a weak rollover situation. So basically what this is indicating is there is some kind of a downside which is expected in the market in the near term. This doesn't mean that your overall or your broader market outlook is negative. Basically it is indicating that your December series could start on a negative note. You could witness some correction, and post some signs of a reversal, you would again start trading aggressively long, right? So having done that, then you would look into the stock internals. So say over here we have the IT space, which is actually showing some signs of strength in terms of Infosys and TCS. These are the open interest outliers. So IT, infra and auto have shown some signs of strength in terms of the positions, right? So we would actually tend to, this would be our watch list for the near term in terms of the stocks that we would want to trade upon, right? Obviously the technicals and the internals of every stock will be looked into before initiating trading positions onto the same. Post this, we also look into the broader market stock specific sector momentum. So we have a proprietary sectorial map which we've developed, which gives us an idea on how the momentum is playing out within sectors. So over here, if you see, banking services is trading positive, financial services, bank nifty. But again, in financial services, we saw a neutral rollover. So we would tend to avoid that sector. Then we have strength in the bank nifty. We saw high rollover in the banking space. So when bank nifty is showing momentum, private banking stocks have shown strong rollover. We would look into that space to identify tradable opportunities for the month of December. So this is how we look at the various tools, club them together and formulate a view to identify strong opportunities which are worth trading. So the broad flow, just to sum up, what is the broader market outlook is what we look at first. Index positioning based on the rollover and the options data. Then we have the sectorial rollover activity, and after that we look at stock specific, like the technicals and the momentum patterns onto the same. I'll just take you through two examples which we Say this was an opportunity that we identified in the month of November, wherein HDFC Bank had over here shown positive momentum data followed by some strong consolidation. Now pre-expiry, that is the end of October series, beginning of the November series, the stock had some negative momentum, but it did not give a breakdown as such, and we had witnessed some strong rollover. There was a rollover outlier in this particular stock. So then we waited for the first sign of positivity and entered into a stock defining a particular risk, right? And that opportunity played out well going ahead, and HDFC Bank gained significantly in the month of November, right? Now what do we expect next? So this is again an opportunity that we have right now. If you see over here, you have strong momentum in TCS, which is built up before the end of November series and starting the December series. Again, as I showed, TCS and Infosys have shown open interest outliers. So this looks like an opportunity for the month of December, and we expect the IT space to trade with a positive bias from here on. So this is how we take a top-down approach, considering various parameters and shortlist opportunities that can be looked into. Keeping time in mind, we could not share more opportunities that we possibly are looking at, but as I mentioned over here, you have the infra space which is looking positive, you have the private banking space which is looking positive. So any stocks which show strength over there can be actually looked into for trading on the positive side, while you have your FMCG and your media space which are showing some signs of weakness. So we would expect those sectors to witness some kind of a consolidation. Shifting to the next part of the presentation, we would talk about the market outlook. So broadly, I think I've already mentioned what do we expect in the short term, but just to run you through the short term outlook. You have a low rollover index situation, which means that there could be some kind of consolidation correction in the market. 11,000, 11,050 is a very strong resistance zone, and the downside support that we're looking at is 10,500, 10,600 on the index. Today we did witness some kind of a correction, but the data suggesting that this correction could actually take you lower towards 10,600 which actually would be a good opportunity to enter into the market. Parallelly, we believe if 11,050 is crossed on the higher side, that would basically confirm the outlook to positive and the larger term outlook to positive. Else, as I mentioned, there could be some consolidation. So IT, infra, auto stocks have shown some build up on the positive side. FMCG, media remain weak, and private banks are showing some kinds of a strength from the BSFI space, right? This is the short term outlook that we have. Now extending our outlook for the larger, for the medium term or the macro outlook on the index that we have. There are a few important points that I wanted to run through. In our opinion, we are in a positive setup for the market, despite the fact that we witnessed a deep correction. I've just, you seeing a table in front of you. This is basically summarizing in a positive setup what kind of a correction have we witnessed in the past, right? So if you see over here, in 2007, from a high of 4,600, we did correct to a low of 4,000 within a positive broader market sentiment. So this was just a brief reaction, or taking out of the froth of the market, getting it to rather fairer valuations, and then again gaining momentum is what I'm trying to summarize from here. So such a situation is not new. We've witnessed this many times in the past, 2007, 9, 12, 16, 18, and approximately the correction has ranged in has been approximately on an average around 13 to 14%. Even now in 2018, from the high of 10,760, we did correct to 10,400 in a rather structural positive market, but with short-term internals or short-term sentiments being negative, such corrections do happen. Why I am focusing on this particular component is, usually after such a correction, it becomes difficult for us to stick to our, it becomes difficult to, remain positive on the broader markets, and you would tend to panic, when the market is falling but not broken a critical support. As I mentioned, that the broader market outlook remains positive. We believe we are in an uptrend, and such a situation is not new. We've experienced such situations in the past as well, as you are seeing in the slide in front of you. Just a fundamental check on, where do we stand. Having your fundamentals in place and your valuation check is also extremely important. So currently you're trading 16.5 FY20 earnings. Your long-term average is around 15. So when we were trading around 10,000 levels, you were around 15.5 times. Currently, after the rally, you were around 16.5 times approximately. So basically, we are near the long-term average. We are not in euphoric situation, and there are high chances that, as the opinion that we carry, that we remain in a positive market environment, that you could witness some kind of a significant up move going ahead. Now, previous tops, you talk about 2008, you talk about 2014, have happened at 22, 23 time forward earnings. So we are nowhere near those particular levels. As I mentioned, that we are at 16.5 times. So the upside in the market is pretty significant, right? Earnings broadly have been in line with expectations. There was an expectational rationalization which also happened because of the developments which happened in the last quarter. But broadly, they have been in line with expectations, and we believe that the momentum on the upside could continue even in terms of the fundamentals. So to sum up, keeping our behavioral aspect on the market along with the fundamental check, what is our view on the market going ahead from here on? We strongly believe that we are in a structural uptrend market. Not every low is important when you talk about trading. You have to identify which low one has to look into, which could possibly be the trend defining level. In our opinion, even in the past, say 1 month, we have been of a categorical opinion that 9950 is a very extremely important level on the market, and we do not expect that to be broken. So we witnessed a strong bounce back from here on to test around 10,900 odd levels. So we still are of the opinion that 9950 is not going to be broken. Any meaningful correction from here on would be a good buying opportunity. Over the next 12 odd months, we would expect the markets to test 11,760, which was the previous high, followed by 13,000 levels, on the higher side. We would possibly, depending on the developments, even be open to revising our targets on the upside. But as of now, since we're just trading around 11,000, being over optimistic also does not make sense. But the overall setup that we have on the market is positive. We expect the market to trade with a positive bias in the medium term and achieve the mentioned targets in the next 12 to 18 odd months. Now, volatility, as has been, is going to remain high because you have significant domestic events, you have your state elections, you have your national elections coming up. Today you had the RBI event. So, we are trading in a domestic as well as a global market wherein developments are happening on a regular basis. You have the trade war which is happening, which could have an impact. So just to give you a recent example, yesterday your US markets were down by 800 odd points, the Dow Jones index, which is a significant move for such an index. So volatility is going to remain high. I think for traders and investors, look at meaningful corrections to actually initiate positions rather than landing, rather than creating leveraged or making high commitments when your market actually is in a euphoric situation. So buy on dips is what we believe is going to work for the next 12 months, defining a categorical risk of around 9950, which we do not expect to break, and we expect the targets on the higher side to be achieved. Now, obviously, when we talk about a reward, the risks also needs to be defined, which in technical terms have been defined. But what are the factors which could actually impact the markets? So you have a political risk, which is there in terms of the national elections. Then you have your crude price has witnessed significant volatility, first a rise, then a fall. So if such a volatile pattern again repeats, then possibly there could be increased volatility on the market. On the trade war front, if you don't have a meaningful resolution coming out from the two largest economies, that could actually have an impact. and steep rise on interest rates, global and domestic, again could have an impact on the market. Just to sum up on the macro outlook that we have, the situations that I mentioned to you earlier in terms of the various corrections that we witnessed in 2007, 2009, all of those years also had a certain kind of a risk associated with them. But when the market tends to define a particular trend, it would tend to, the chances of it achieving its target are more than actually witnessing a pattern breakdown. Any event which would have a negative impact would possibly delay the the positivity which is expected to play out. So maybe as against a 12-month period, you could expect our targets being achieved in the 24-month period. But we strongly believe unless the technical or the structural level of 9950 is broken, you are in a positive setup environment, and any dip would be a meaningful opportunity to commit to the equity space with a defined risk. So this brings us to the end of our presentation. Now we'll be taking up some questions and answers, and yes, so can we have the questions and answers, please? Right. So there are, we will be picking up important questions that we think will be in larger interest. So what is the open interest analysis is one question by a participant. As I've mentioned to you, the open interest needs to be looked into keeping in mind the broader market environment. In a positive setup, a strong rollover situation month on month basis gives you signs of positivity, and you can remain positive in the underlying or the index per se. And in case if in a positive environment you have a weak rollover situation, that means the particular stock or the underlying is expected to witness some kind of a correction and then chart its further course of action. So open interest analysis, the broader market outlook, the index open interest view, followed by the stock specific or the sector specific view is what we tend to follow. Then is futures and options, I'm so sorry, just a minute. Is futures and options same as derivatives? How can I understand using trading on the Kotak portal? So, I just briefed you on the futures and option space. They are a component, or there are instruments in the derivative space which you can trade on the Indian exchange. You have the index futures, stock futures, index options, stock options. All of these are a part of the derivative trading space. How do you trade? You can possibly contact our local team with respect to your RM or your local branch. They would surely help you out and give you a demonstration onto how do you use our portal. Is call buying or selling a better strategy? What is the key difference between call buying and put selling? I think this question is of extreme importance. Call buying and put selling, though both of them have a positive outlook, the risk in both of them is different. So when you buy a call option, your risk is limited to the premium that you're paying for that particular contract. Whereas when you're talking about selling a particular put option, in that case, the maximum gain that you will make will be the premium that you have pocketed or you have collected from the market. But in case if your view goes wrong, then the downside risk remains unlimited, because that particular stock, in case of an unfavorable movement, could fall significantly. So though the view of buying a call option and selling a put option is the same, but the risk component in both of them is significantly different, and that needs to be very clearly understood before initiating a particular trade, right? Can we use derivative signals for medium-term investments? I believe you can actually extend the derivative analysis for medium-term investment as well. So if you have a good opportunity, a strong setup technically, and on the derivative indicators also you have positivity, so that view is going to remain hold good for a particular time frame. With respect to derivatives, maximum we look at is 1 to 1 expiry. So the medium term that you define over here is 30 odd days. I think taking a larger view on and on any particular underlying from the derivative space would be a bit difficult, and for that you would refer more to the technical aspect of the market. Futures or options, which is a better bet? So again, every individual has a personality of his own. So there may be one particular trader, investor who would be more into aggressive speculation. There would be someone who would be rather low on the speculation side. So I think depending on what your profile is, you would actually tend to select the particular instrument that you would trade upon. It is difficult to give an answer in black and white to suggest which of these instruments is good. I think it more has to match with your trading personality, and then you should take a particular call on decision as to which instrument are you wanting to trade upon. We'll take another question. So we have a question on the put call ratio in the option space. Now the put call ratio again is an advanced concept that we've not covered in this particular series, but just to give you a brief, put call ratio is nothing but the total put open interest divided by the total call open interest. That basically gives you an idea of what is the market anticipating, who's more aggressive, is the put side more aggressive or is the call side is more aggressive. So usually in the market what we've seen is the Nifty put call ratio in the range of say 0.8 to 1.5. These would be the extreme ranges that we would look at, and any touch of these ranges on either side infuses a significant volatile movement in the market, because a 0.8 put call ratio basically means that there is aggressive call writing which has happened, which means that market the people are extremely pessimistic on the broader markets. Whereas when you talk about a 1.5 put call ratio, you basically interpret it as your put writers are very, very comfortable and they've created significant positions in the market. So historical range is 0.8 to 1.5, and within this range it is difficult to interpret put call ratio, though you can use put call ratio for your intraday short term trading as well. But broadly, this is the range that the Nifty 50 index has been following and has respected most of the times. So what is your, we have some questions on the auto space and the NBFC space. As I mentioned, NBFC currently is showing some kinds of consolidation. We do not expect massive action from here on. There could be some stock specific movement, but entire as a space, I think after the correction that we witnessed, we could have some kind of a consolidation in the same before we move ahead and see a meaningful bounce back. Right. So we will end the session over here. Thank you so much for sparing your valuable time and attending this session. I hope we could help you in understanding concepts on the market. We've categorically communicated what is our outlook on the market for the short term as well as in the medium term. We'd appreciate your feedback and that will help us in building the next webinar, structure it in an effective manner so that all your needs are taken care of. Thank you so much for attending this presentation. Thank you.